So thank you and welcome to today's seminar of the Independent Evaluation Office. The objective today is to discuss the exceptional access policy of the fund, also in the context of the evaluation that the IEO has conducted and that was published last December and that you may find in our webpage. Let me first welcome the participants in today's debate. So I want to welcome Rishi Goyal, who is Deputy Director of the Strategy, Policy and Review Department of the Fund, Son Hagan, non-resident Senior Fellow at the Peterson Institute for International Economics and former General Counsel of the Fund, Carmen Reichard, the Minos Zombanakis Professor of International Financial System at Harvard Kennedy School, Hector Torres, Senior Fellow at CIGI and former Executive Director of the IMF, and I'm Pablo Moreno, the Director of the IEO. So the idea is to have a debate on the policy today, and then we will leave some time at the end of the discussion for questions and answers. Maybe as a way of introduction, let me just try to briefly summarize what are the main elements of the evaluation that the IEO has conducted on the exceptional access policy. At this stage, I would like to recognize the excellent analysis conducted by the evaluation team and the consultants, and especially to the team leader, Vivek Arora, and to the lead evaluator, Miguel de las Casas. So the evaluation assesses the exceptional access policy of the fund from its adoption in 2002 until mid-2023. It assesses 38 arrangements conducted by the fund during this period of countries that access to fund financing above the so-called normal access limits, which are defined in terms of quota. The policy was established in 2002 to address what were the perceived problems of the previous basically discretionary system, where the fund approved exceptional access programs on an ad hoc basis using the exceptional circumstances clause. And when the policy was established, it tried to address some of these problems, and it had four stated objectives, which were to set expectations of when the fund will get engaged in exceptional access cases. Second, to provide benchmarks for program design. Third, to safeguard the the resources of the fund and boost its catalytic effect. And fourth, to ensure a uniformity of treatment. So, building on the principle of the fund that higher access must be accompanied by higher safeguard, the policy did introduce three main elements for exceptional access cases. The first one was for exceptional access criteria, which were determined in terms of the size of the balance of payment needs, a high standard for debt sustainability, prospect for market access, and reasonable strong prospects of program success. The other two elements introduced by the policy were some mechanisms on enhanced decision-making procedures and involvement of the board, and the introduction of ex-post evaluations for all exceptional access programs. I think it's important to signal that from the beginning of the exceptional access policy, and also this has been a theme of the evaluation, there was a need for the fund to try to strike a balance between rules and flexibility. So the new framework of the exceptional access policy provided higher scrutiny for exceptional access cases compared to the previous fully discretionary system, but it did also introduce some elements of flexibility to ensure that the fund could attend the members that needed or that had balance of payment needs. And the two main elements of the policy were the room for judgment in assessing the exceptional access criteria, and also, at least until 2009, it kept alive the exceptional circumstances clause in principle for non-capital account crisis. I think in this context of the debate between roles of flexibility, it's also important to signal two reforms that were introduced in the policy. One in 2010, when the fund introduced the so-called systemic exception clause in the context of the Greece crisis, to be able to lend to Greece in a context where it did not meet the high probability standard or bar of debt sustainability. And a second reform also in this case in 2016, which eliminated the systemic exception clause that had been introduced in 2010, but it substituted it with the so-called great zone of debt sustainability, whereby the fund can lend even if the debt of the country is sustainable, but not with high probability. Again, as a key element of the flexibility within the framework. So moving into the main findings of the evaluation, basically, what the evaluation finds is that the policy improves the previous discretionary system because it provides it provides an institute, it systematizes the institutional decision-making of exceptional access cases. But it does find some shortcomings, and it also finds that the policy did fall short of its stated objectives. Some of the problems that the policy finds include it did not provide a substantially higher standard for exceptional access programs compared to normal access cases. The policy may have contributed to delay in the resolution of debt problems and failed to catalyze private financing as it was envisaged. Similar to normal access cases, exceptional access programs have often been associated with repeated use of fund resources and with continued the vulnerabilities. And there are also problems of perceptions of lack of even-handedness in the policy, which are mainly related to the ad hoc reform of the policy linked to high-profile cases. The evaluation also finds some problems in terms of the gaps in the exceptional access criteria. For instance, there is no clear frameworks to assess or guidance to assess exceptional access criteria 3 on market access or exceptional access criteria 4 on program success. It finds some problems on the debt sustainability criteria in terms of the different roles of domestic or external creditors or the type of creditors. And it also sees that there is further room for improvement in the enhanced decision-making procedures or on the use of the ex-post evaluations as a learning tool for the policy. And within these findings, the way forward that the evaluation proposes 5 recommendations that try to again strike this balance between rules and flexibility. I will highlight 4 main elements of the recommendations. The first one is that the evaluation proposes to place greater emphasis on the strength of the program design, on its disclosure, and a clear consideration and risks of trade-offs of the program. Second, it proposes to address the gap and strengthen the clarity of the exceptional access criteria. This goes in the direction of strengthening the rules of the framework. Third, as a way to compensate and also to maintain the flexibility of the policy, it proposes to consider the reintroduction of the exceptional circumstances clause in rare and well-justified cases. And fourth, it also proposes the strengthening the application of the decision-making procedures, the use of the ex-post evaluations, and the link of the exceptional access policy with the enterprise risk management framework of the fund, which admittedly was only approved in 2022, so it's natural that they were necessarily linked. So in essence, what the evaluation proposes is sort of a transparent exercise of flexibility through enhancing program disclosure, clarifying the rules of the framework, and in this manner trying to improve the accountability and the even-handedness of the policy. So with this general introduction, I think it's useful if we move directly into the debate. I have to say also that we are all speaking on a personal basis, so also for the different participants. So and again, after the discussion, we can move it at the end of the seminar into a Q&A session. So first, let me just start with a general question to participants. No? So on the main weaknesses and strengths of the evaluation. Again, the evaluation, the overarching finding is that it was useful in some respects, but it did fall short of its stated objective. So I will ask the panelists, what are your views on the effectiveness of the policy? What are its main strengths and weaknesses? And is there a need to reform it? And what would be the cost to the fund if there is no reform of the policy? I'm not sure. Maybe we can start with you, Sean. Sorry to go directly.
So thank you, Pablo, and thank you for inviting me to join this discussion. I think the evaluation is a really important one, not just because of the centrality of the exceptional access framework for IMF lending, but I think the issues that it raises touch on the role of IMF lending more generally. And I know that there's going to be a conditionality review in the fund, and I think this is relevant also to that. So I don't agree with all aspects of the evaluation, but I do agree with 2 of the central findings. The first is that it hasn't achieved the objective of raising standards for IMF programs and lending. And that was a critical objective. I mean, as you pointed out, the level of conditionality in the fund always is, in some respects, articulated in terms of the level of access. So first credit tranche is the most permissive, upper credit tranche is stricter, and exceptional access is supposed to have the highest standard. And it's relatively clear from your report that that substantively higher standard never materialized. The way the policy was to achieve that was to basically replace the sort of optimism that characterized, for example, the 2001 program with Argentina, which was a major reason why we adopted this policy. I think that the lessons from the Argentina program were very central in the executive board mind to replace that optimism with realism that was to be achieved by really scrutinizing programs and replacing optimism with realism. But I think the IEO finds that, ironically, normal access programs were less optimistic than exceptional access programs, that there was even greater optimism ex ante for exceptional access programs. So something clearly has gone wrong. My view is that the problem is not so much in the design of the policy, but its implementation. And I think we can talk about that at a certain point in terms of the pressure on the staff to basically lend when essentially, if a strict reading of the policy would find that the standards have not been met. But I do believe that this is the second point I would make is that it really does pose risks for the IMF. And that is another finding. And why is that? Because essentially it means that we're going to have programs that are not successful. And one of the reasons why they're not successful is that, especially for emerging markets, success of a program requires the fund to play a catalytic role. In other words, being able to basically help a country return to market access. And again, the finding here is that exceptional access programs have actually been less catalytic than normal access programs. So this is a problem, and I think that therefore there is need for significant reform. We can talk about the reform that are suggested by the IEO. I have my views on those, but perhaps we can discuss that as a second round, Pablo. Thank you.
Yeah, we will move to some of the specific recommendations. Maybe can I, I know we are all speaking on personal basis, Rishi, but I'm moving to you to react on, because you're the only one representing the staff here in this discussion. If you could, what are your views on the strengths and weaknesses on the policy?
Thank you so much, Pablo, for inviting me as well to be on this panel. And let me commend you and the team for the report. I personally thought that the report is very helpful. And it will be as we go about doing our own review of the exceptional access policy that the board has called for. Look, from my perspective, the exceptional access policy, as part of the broader lending policy framework, plays its role in that its key purpose is to add frictions. Its key purpose is to add frictions to ensure that decisions on exceptional access are made in a deliberate and thoughtful manner. And the principles underlying the policy are sound, they're simple, they're transparent. Your report essentially says that the 4 substantive criteria are very sensible. So, the policy itself seems to be on pretty good footing. Without contradicting Sean, let me clarify a little bit from my personal perspective, what I thought was missing in telling this story. I think number one, we need to see, as Sean said, that this is part of the broader framework. So we need to ensure that the broader lending framework is functioning as it should. As you know very well, the North Star of all our lending is to ensure that our members are able to resolve their BOP imbalances, put in place the measures that resolve them, and that itself is a key safeguard for the use of fund resources. As part of the ongoing review of conditionality that Sean referred to, we've done work which shows that the key to successful arrangements is really very strong ownership, where you have countries that come in a timely manner to the fund or in a timely manner undertake the necessary adjustment measures, they are more successful in addressing imbalances and building resilience. And where there are delays in this process, problems become more entrenched. And this is true for normal access cases. It's also true for the exceptional access cases. And if it is more entrenched, it's going to take more time. It's going to take more effort to be able to address it. So I'm not actually surprised by the findings that you have, in part because many members, because of the stigma issues and otherwise, tend to wait before they come. So you end up with more entrenched problems to deal with. The second is, given that the problems are more complex, I think we also need to be mindful that the context has changed. When the policy was designed, it was designed in the context of the Great Moderation. What worked when, what you refer to as capital account crisis, but not just capital account crisis during the Great Moderation. When you move to deeper and more entrenched problems, such as in the euro area, or even more recently, systemic shock upon systemic shock in a weak growth context, and given the outlook of growth and trade, one has to see how programs are going to be successful. And it doesn't really matter whether it's exceptional access or normal access. But to me, what this calls for is judicious application of and tailoring of what we want. Judicious, not mindless, right? It's not just because it's written there. We need to be thinking about how we tailor it, because we cannot write complete contracts when we get there. And the same is true not just when the external context changes. The same is true for a program. You're in the middle of the program. You've given front-loaded disbursements, and circumstances change in that program. We're stuck with that. My final point, and I look forward to coming back to this because you have some recommendations on this, it relates to incentive compatibility. I think what we've seen in the last 20 years is that there is a great desire for a common and simple framework, right? Not to have too many things in parallel, not least because we don't want to be sending negative signals. And when you have deviations from the standard framework, you could have adverse signals that are sent. In your report, you talk about the 2009 reform, which broadens it from capital account crisis to all types of crises, and to how the exceptional circumstances clause, which you referred to, fell into disuse. So how do we deal with these problems that do not fit within the standard framework when there is a desire to maintain and keep within that framework? I'm sure we'll discuss this further, and I look forward to that. Thanks, Pablo.
Yes, following on that last remark, Rishi, and also asking you, Hector, and Carmen, sort of the general question. So one of the precisely of the debates and of the central debates of the policy through time is this debate trade-off between rules and flexibility. So like you were saying, Rishi, in some instances, there is a need for the fund to attend the member needs, even if meeting the exceptional access criteria is difficult to ascertain. But then on the other side, and there is a big debate within the institution across the management board and the staff, those who defend flexibility, and on the other side, those who defend the rules, which is it's a better way to defend protect the fund resources, or also maybe in the longer term economic interest of the country. So also taking into account this trade-off, I don't know, Carmen and Hector, what would be your general views on the policy as well? Carmen.
First of all, thank you for inviting me. And can you hear me?
Yes, perfectly. Yeah.
Okay. And I, enjoyed reading the report. I don't agree with all of it, but I found it very useful piece. On the rules versus flexibility, rules are only as good as they are credible, right? If you have a time and consistency problem in which the rules are followed in good times when they're not binding, and we go to exceptionalism when they do bind, what is the point of the rule? It undermines credibility in an important way. And so I think it's more like we have guidelines We have criteria and so on, but I think in the end, discretion is what in practice has dominated, and I really don't see that changing. I do want to echo very much the main points that Sean made, and I hope I have an opportunity to revisit some of those themes, because I do think that if we are going to consider further transparency and more rules based and so on, I think we really have to revisit the criteria big time. And so I hope we have, but on the rules, as I said, I think the fund has the exceptionalism around Greece had certainly credibility effects, and so I don't expect that time and consistency problem to be resolved, to go away.
I think we will move also into the specific criteria. So maybe do you have, Hector, some general remarks also in the context of this debate before we move to the specifics?
Yes, Pablo, and thanks for inviting. And I also like the report, and perhaps I'm maybe one of the few that is very much in agreement with perhaps the most controversial recommendation, which is the reintroduction of the exceptional circumstances clause. And that brings me to this question that you're putting, the contradiction between flexibility and rules, and whether we strike the right balance. When someone has an accident and is rushed to the hospital, medical staff priority is clear. They have to stop the bleeding and ensure that the victim, the patient, is breathing. Of course, they follow a protocol, but since every accident is different and mostly unforeseen, doctors must act with flexibility to be effective, to save lives. Just like what happens in emergency medicine, dealing with country's accident also requires flexibility. Crises, very much like accidents, are very much unique. And so while IMF staff must follow certain rules or protocol, a set of rules, very much like doctors, they also need room to tailor adequate responses and timely responses. However, if you tighten the rules too much, we're risking the danger of forcing staff to prioritize legal justifications over practical solutions. And the focus in that case would shift from crisis resolution to bureaucratic maneuvering and bureaucratic, I would say, justifications. So instead of designing effective responses, staff would be spending precious time in massaging facts and assumptions to fit predefined rules. The result would be justifications rather than solutions, and a loss of IMF credibility. Now, I ask to myself, does the current configuration of exceptional access policies strike a balance between rules and flexibility? My short answer is no. Tightening the rules won't stop IMF most influential members from exerting pressure on management and staff. Stricter criteria, if pressures continue the same and are not inhibited by stricter criteria, would only push staff towards even more creative legal reasoning to justify compliance with exceptional access criteria, particularly the last three, which are the most subjective of all. Political pressures are already stretching staff's imagination to assert compliance with exceptional access criteria. Strengthening existing criteria, in my view, would only worsen this situation and ultimately undermine the fund's credibility. And one point, last but not least, this is a time of growing global uncertainty. Limiting IMF's ability to respond effectively and flexibly, providing responses that are effective to crises that are unique, would be, in my view, a dangerous mistake, particularly at this time. It would encourage countries to bypass the fund in favor of bilateral solutions, bilateral deals, if you want, weakening the IMF's role precisely when it needed most. So that's my answer to your question.
So thank you, Hector. Let me move now into the into the specific elements of the policy, starting first with the criteria that you were mentioning before, Carmen, and others. So the evaluation does find some shortcomings in the criteria. On exceptional access, criteria 2, which is debt sustainability, is the cornerstone of the policy according to most stakeholders. It finds some problems in terms of defining the different types of creditors and the role of domestic and external debt. And it also finds some problems in the so-called gray zone, which is, again, a key element of flexibility of the policy, but also it might introduce not necessarily the right incentives for program strength and implementation of the operations. There are also the same type of issues in exceptional access criteria 3 of market access, which doesn't have a well-defined framework. And there are unclear links between exceptional access criteria 2 and 3. So let me ask you, what do you see? You were mentioning before, Carmen, that there needs to be an improvement in those criteria. What are your views on how to, particularly on the debt sustainability and market access criteria? How would you see a way forward for the policy and the problems that it has?
So let me begin by saying something about the 4 criteria. The only criteria we're really sure of is the first one, that they have balance of payments needs.
Yeah.
That's the only one that we're sure of, that they have balance of payments need. Beyond that, it gets more speculative. Turning to the debt sustainability, I'm very scared of the gray zone because it only says, well, initially we were supposed to lend only into sustainable debt. Now we are lending into sustainable, but not really sustainable. And this, I think, in the report, it highlights that indeed the failure rate is twice the success rate, right? The report highlights that, in effect, and Sean alluded to this earlier, regular access does not do stellarly. It's only, around a third of the programs that are successful, and extended access does even worse, slightly, but so clearly there is something wrong with the lending criteria. And I think you're right to point out that the crux is the second, the debt sustainability, the over-optimism problem. I think it sets the stage for program failure. It sets a stage also for creating, and I think it sets a stage for program failure, whether it's regular access or extended access. But the more dangerous part of the extended access is, of course, that the stakes are higher and the potential impact on the fund's financial health is even greater. And because of that, because it's even greater, I think one of the concerns I have about the combination of over-optimism, gray zones, and exceptional access is that it puts the fund in a position where we are now, this is noted in the report, where we've have these huge exposures to a selected group of countries like Argentina, Egypt, and I think it sets the stage for all kinds of problematic practices in terms of subsequent programs that are really there to evergreen the initial lending, and that they occur because repayment of the fund would be questionable. This is certainly what Argentina looks like to an outsider, and so it all originates with the problem of calling an unsustainable debt case, a BOP crisis, a liquidity crisis, and not a solvency crisis. So I do think, and then this ties in, of course, to the other two parts, the over-optimism surrounding the debt sustainability spills over to over-optimism, which, as the report notes, is not really articulated or analyzed systematically. It's more an assertion that there will be private funds forthcoming. That has been, of course, disappointing. And, I think, again, I will go back to my previous point that the tightening of criteria, I think, really, if you want to have, I think, a serious impact, is basically, more realistic debt sustainability analysis. But we've known that for some time. And again, there's a lot of pressure to call things sustainable, gray, or otherwise, when they're not. I think that's the crux of the problem, and we've known that for a long time.
Thank you, Carmen. So indeed, in this respect, the evaluation that does recommend that there is at least the expectation that the country will move out from the gray zone, at least during the duration of the program. It also proposes clarifying the terms of conditions, in the direction of strengthening the clarity of the rules, strengthening or clarifying the framework for exceptional access criteria 3 on market access, which some question in the sense that it can reduce the flexibility of the room for judgment. I don't know, Rishi, let me again turn to you on this one. What are your views on these proposals or possible alternatives way forward for those criteria?
Thank you so much.
Sorry.
I'm sorry, I thought you were directing that question to me. So
no, it's fine. If you want to react, Carmen.
No. I was confused.
Rishi, please.
Okay, thank you so much, Pablo. I guess I have a bit of a sunnier view on some of these issues. I mean, first, EA2, while I recognize, of course, that it's perceived to be central, I would put forward that I think EA4 is equally, if not even more, and I think you have that in the report too. Ownership of a strong program, for sure, is critical. EA2 is also helpful, I think, in that it's not just the exceptional access programs for which we see EA2. There are countries that often make the choice, or if they have the choice, they may choose not to go into exceptional access because of what they see in terms of these criteria. Look, I was in Greece more than a decade ago and saw some of this play out, and I have to tell you, I think we need to be extremely humble about what we know and what our frameworks can tell us in context of very significant change. Our frameworks were not very well attuned to understanding how to bring in the support that Europe was essentially promising that it would, support that evolved over time and became critical to helping Greece alongside their own very, very significant adjustment that brought it. I think our sustainability frameworks right now are significantly improved. They allow us to think in a much more systematic manner about these things. They also help us, I think, in terms of the balance between type 1, type 2 errors. It helps us. And I'm sure, we will need to continue to think about this. I think what comes out very clearly from our work with the debt sustainability frameworks is that judgment is critical. We need to augment what our models are telling us with judgment, and it outperforms either just simple judgment or what the models themselves are saying. On this issue about the gray zone, look, this was debated the last time. We will, of course, go back to the board and see in terms of their risk tolerance and how they want to see this. To me, debt restructuring should be done where it is necessary and only where it is necessary, right? Where there is reasonable uncertainty about things, I think it's important to be focused on the program and trying to bring the program back on track. Otherwise, inadvertently, there would be the prospects of raising deeper debt restructurings, which come back and can harm the catalytic effect of the program. Pablo, if I may, you had also talked about the links to EA3, and of course we're quite mindful of the conceptual as well as the other links that are there between EA2 and EA3. Which we will look at, and we'll try and see as we go forward how to refine, taking into account some of the advice that you have given. But I'd point out that the prototypical adjustment that people seem to have in mind is you have an EM, it has some imbalances, it gets hit by a shock, you do some front-loaded adjustment or announcements of front-loaded adjustment, you provide sufficient fund financing, there is it restores confidence, capital comes back in, and the currency depreciates, and then you essentially contain your spending, so revenue rebounds with growth, and you're able to grow your way more or less out of the imbalances you're able to get out of it. I think that either you see this as a capital account crisis or you see this as a dynamic that worked during the Great Moderation, but it's not something we've seen since then, right? Since then, you've seen much, much more entrenched problems. You see much deeper problems. It takes time to work out. These dynamics are not there. Growth is much weaker. It takes time, which is why in both normal access and exceptional access cases, it takes time. It takes sort of repeated arrangements. I'm not sure that jumping the gun and thinking through in terms of moving quickly on debt restructuring is necessarily the response. I think making sure that we have the program more or less on track, trying to work through that, and in that context, also thinking through what catalytic effects might mean, how to measure and how to think about market access, because we do want market access. It's important in terms of sustainably financing the obligations that are falling due. I'll stop there. Thank you.
Thank you, Rishi. I don't know, Carmen, if you wanted to react on this. Yes.
So just picking up on the issue of market access and confidence building and the problems with restructuring. Certainly restructuring is not designed to, it's not something to be taken lightly. But how many programs do we see the IMF come in with the expectation that private capital will follow, and private capital doesn't follow? In effect, if the private sector has an assessment that suspects the debt is indeed unsustainable, and that now the country has even bigger exposure to a senior creditor, what would be, of course, the incentive to go in, to go and lend onto that situation. So I recognize that, one shouldn't jump the gun on debt restructuring, but I am making the point that, if you go back to the 2017 board paper that evaluated a lot of the IMF programs, the optimism bias was, this. So the errors are not one-sided. I mean, the errors are all one-sided, and I think that that speaks to, having, we have the type of error that we tend to call things sustainable that are not. And I think that is importantly related to a lot of the failures we see in the programs.
I'm mindful of the time, and there are a couple of issues that I still want to, that I want to have on this debate with, or at least three main ones, which is the centrality of program design, political pressures, and the exceptional circumstances clause. So I know, Sean, that you've been critical of the exceptional circumstances clause. What the issue proposes is, if you strengthen the rules, you correct these issues of of the great zone, you try to improve the catalytic effect of the fund, you maintain the room for judgment on the criteria, like you were mentioning, Rishi. But there are circumstances, unforeseen circumstances, where it might be useful to have the exceptional circumstances clause, again, rare and extreme cases where there can be the political decision to approve it. But I don't know if you've been critical of it, and what would be your views, and what other alternatives do you find to improve the framework in that respect, to maintain its flexibility?
Yeah, so let me try to explain why I am concerned about the proposal on introducing an exceptional circumstances sort of escape clause. Let's start with the existing framework. As Rishi has said, really, I do believe that criterion 4 is as important, if not even more important, than criteria 2, which relates to debt sustainability. But debt sustainability is singled out for a particular reason, right? Which is that essentially many, but not all, of the cases where exceptional access is provided are cases where countries come to the fund because they've lost market access and they need to make payments to private creditors, and they want to use IMF resources to basically, avoid a default. And, the funds, as long as the country is adjusting in a way that the fund thinks is appropriate, the fund also wants to avoid a default. I mean, the fund doesn't want default because it creates economic dislocation in the country, it creates contagion, and therefore the fund is happy to provide large amounts of financing to support strong adjustment programs, even if it means creditors getting repaid in full. However, and this is the point where debt sustainability comes in, the fund has decided appropriately that it can't do that where debt is unsustainable, because at that point, a debt restructuring is inevitable. And therefore, it's not helping the country for that debt restructuring to be delayed. In fact, it's making the situation worse. So that's why it plays a central role, okay? So the question that I have is, with the exceptional circumstances, is if you have a situation where there really is concerns about debt sustainability, but we want to go ahead anyway through an exceptional circumstances, who are we helping? Well, we're helping the staff because the staff can be more transparent. The staff doesn't have to try to justify the unjustifiable. It's more transparent. But are we helping the country? I don't think we are. And in fact, to the extent to which the programs work because they catalyze market confidence, signaling that we're using the exceptional circumstances clause is only going to send a signal to the markets that the fund really has concerns about sustainability. And in those circumstances, I don't see the market coming in. And in fact, as Carmen has said, one of the findings of this evaluation is that the larger the IMF footprint is, the more our resources replace private claims, the bigger the concern is going to be about the private creditors coming back in. So that is why My proposal, and I published a couple of articles on this, would be actually in circumstances where there are concerns about sustainability in the gray zone, there would actually be a hard access limit. And in those circumstances, the fund would not be in a position to provide more financing, because the more financing we provide in those circumstances, the less chances are that the program is going to work because of the anti-catalytic effect.
Thank you, Son. I don't want to engage in a debate with you on this, but because we've discussed about this, we have some other considerations. But I want to move forward with some of the other topics and also leave some room for questions for questions and answers. So let me, there is also another element, I guess, of the proposal, and you all have mentioned it, which is the centrality of program design and of ownership. And there are also issues of political pressures and program design. So so the evaluation, it does raise these questions of political pressures. They have in some instances affected debt operations or capital flow management measures, and they have affected maybe the program effectiveness. And in some instances, like Argentina and Ecuador, they might have affected also the sequencing and the phasing of the programs. So maybe move to you, Hector. I'm sorry, I'm taking advantage that you are the Argentinian in the group. So what are your views? Basically, the way forward, the evaluation, what does propose is, let's have a higher bar of disclosure and explanation of trade-offs and risks to the program. It's putting it at the center of the policy. And again, this goes along the lines of what you were mentioning before, Rishi, which is elevating EA4. EA4 is more about the prospects for program success more than the second part of it, which is political assurances. So bringing the centrality of the program. So what are your views on this proposal, Hector, and how do you see, the way of overcoming the political pressures that are naturally there, because this is a political institution. The IMF is a political institution. So Hector, back to you.
I followed very closely the program of 2018 with Argentina, and that was clearly an example of political pressures. Staff was very aware of the risks, and particularly about the risk of front-loading a program without front-loaded adjustment policies. And they asked the fund, the authorities, to impose capital flow measures together with the program. The authorities refused, saying that it was unthinkable because the president had taken office. Precisely the first thing he did was removing capital flow measures, and he was running for an re-election, and he didn't want to impose them before the ballot. And he had the Trump's ear. Otherwise, they would have insisted. So when he said no, or the authorities said no, then they proposed reprofiling the debt. And the government said no again. Eventually, the government ended doing both things, imposing capital flow measures and reprofiling. But, it was way too late, way too late. I would say this is not something that you could prevent by tightening the criteria, because the political pressure is there. This is something that is a governance problem, because the board was too keen to accept what the main shareholder of the fund was backing for. And many directors, and I can understand it because I was in that position, don't want to disagree with with management, because it could be very costly, particularly when your constituency is borrowing from the fund. So I would say this is not a matter to fix with tinkering the rules. It is not that. It is a governance program. If some criteria have to be strengthened, it is a criteria to select board members, not to force staff to be imaginative in justifications. Indeed, the program with Argentina, when the government said they didn't want to accept, At the beginning, they had shot for an FCL. Of course, the exceptional, the criteria for the very strong fundamentals were not there. So they finally went for a precautionary, supposedly precautionary SBA. But as the political pressure was there, they managed not to make it precautionary, to have a 15 billion disbursement and to upgrade the program from 50 to 57 billion. I remember at that time, and this is another thing that came to my mind when I heard Carmen just now speaking about what is the right medicine. I remember that at that time I met one of our colleagues, and I will not mention his name, but he's in London in an investment bank. And it was just, the program had just been signed. We had 57 billion at our disposal. And he was recommending his clients to sell Argentina's debt immediately. And I asked him, you must be mad. I mean, we have this huge program. And he told me something that I remember very well. He said, IMF support is like a medicine. The right dose brings the catalytic effect we all want. An overdose is crowding out private creditors, precisely for the reasons that Carmen mentioned. I mean, too much exposure to a preferential creditor is not the kind of enticement that we need. So I think I answered to your question on that, if I'm correct, Pablo.
Yeah, so thank you, Hector. I want to move to, so again, I'm mindful of the time and we have to finish at 1 p.m. And I mean, you may also want to have some final, reactions by all of you, but I want to move to the questions. Sorry, Amy, I'm unable to activate Miranda Safa. Can you please activate her? There you go. I can do it now. Okay. So I want to signal why I give the floor to Miranda, that this is not an evaluation on Argentina, just to make also that clear. But there is also another high profile case, which was, that was one of the high profile cases, like the case of Greece as well. And I think Miranda is from Greece. So Miranda, I think you have the floor now. You had your hands raised. Do you want to ask your question? I think you have access now. And I will ask the rest of the attendees to raise their hand if they want to intervene. Miranda, can you hear us?
Oh, yes. Can you hear me now?
Yes, yes.
Okay.
Please.
So a couple of points I wanted to make. First, the expectation that debt sustainability is restored with a high probability during the program period is something I proposed in a paper published in the Journal for Globalization and Development back in 2022 in a volume on debt, on sovereign debt, edited by Ugo Panizza and Andrea Presbitero. So, I'm sorry to see that this is now being promoted by the IEO as if it were a novel idea without reference to that earlier paper that was, by the way, reviewed by SPR in April of 2022. But the point I want to make is that in that same paper, I regretted the fact that the fund did not require reprofiling in the case of Argentina in the 2018 program, even though Argentina clearly fell in the gray area case and had essentially lost access to capital markets, if properly defined, to refer to FX access and not to carry trades that can be unwound at a moment's notice in local currency. So my point is that the problem is not really the criteria per se. I think the criteria are excellent. It's that the policy, the reprofiling policy that the fund came up with was never really implemented. In the case of Argentina in 2018, it was blindingly obvious. In the case of Greece back in 2010, if that policy had been in place, it would have saved Greece more than 40 billion of official borrowing in the first 2 years of the program, and this money was being used to repay private bondholders, when in fact, if the debt had been reprofiled, Greece would not need to borrow that money. So I would appreciate comments from Rishi or anyone else in the panel on this.
Thank you, Miranda. Let me move to a quick question by Ramiro Tosi, and then move, because we don't have much time, and then final reactions by panelists. So Ramiro, I think you can make your intervention if you can speak now.
Yes, thank you, Pablo, for having me the opportunity to intervene. As an IMF actor, I had experience with working with the staff of the IMF in the context of the EFF 2022. I work in the Ministry of Economy with Mr. Guzman. So I think that one of the key issues here is something that Hector and Carmen mentioned, in the way that at the end of the day, let's say exceptional access criteria seems to be, let's say, objective rules to pursue by the staff and the board members. But at the end of the day, the final decisions, no matter how these exceptional access criteria are applied, depends on a political component related to the board of directors. And I think that if the board of directors thinks carefully about the enterprise risk they are exposing the fund by disbursing, let's say, massive amounts of money to countries that do not, let's say, fulfill the let's say, the objectives of the programs or even the criteria, that imposes a cost not only on the, let's say, countries that apply for the financing, but also for the other constituent of the fund, because they are financing countries which are, let's say, not really acceptable in this term. So I think that there is a missing, let's say, exceptional access related to the, let's say, board of directors' own judgments. So there should be something that applies to members of the board in the sense of, well, you should, let's say, be clear that you are in a way accepting some enterprise risks of the fund, and you should, let's say, make it clear for the rest of the countries that at the end of the day are financing the fund itself. So I think that this should be a way forward to, let's say, avoid something that Carmen has already said in many papers along his history with this type is different. So every time there is a program with exceptional circumstances, at the end of the day, the message is, well, these times will be different. And we know from the experiences that in most of the cases, that's not the case. Thank you for having time.
Thank you, Ramiro. So I will ask you to make some final comments. I have Sean first and then Carmen, please.
So, Pablo, actually listening to all the panelists, I think that there is one area where there's a consensus, and maybe I'm wrong, but which is that the principal problem is not really the design of the policy, but its implementation. And the problem with its implementation, I also think there's a consensus, is because of what you refer to in your report as political pressure. So let's talk a little bit about that. So even though where there are circumstances where the lights are flashing red on sustainability, and in those circumstances, it's in the interests of the fund and the country to move forward with the debt restructuring, there are generally an alignment of interests against a debt restructuring. The Minister of Finance will possibly lose his or her job. There will be potentially contagion in other countries. So the pressure comes from a number of sources to avoid a restructuring. The only point that I would make is, if that's the problem, do you resolve it by just having disclosure, by being transparent? Yes, it helps in as much as it addresses accountability with the staff and the board, as Ramiro just said. It's clear. But here's my question. How does that help the country? How does a delay in the restructuring of unsustainable debt help the country. It helps the Ministry of Finance. It helps the staff because it's more transparent, but it's not helping the country. And I think that as you think about solutions, we need to find a way of addressing that issue, which is to make the program work.
Thank you, Sean. So we are above of time, but I think I'll give you a final word, Carmen, and then Hector, and maybe Rishi if you want also as well. A couple of minutes more.
Just a note, and coming back also to Miranda and Sean and others, importantly, have raised the issue. Again, I'm not someone that is advocating that debt restructuring is to be taken lightly, but delays are very, very costly. I have a whole range of research showing how lending, whether it's official lending or in the old days, in the 1980s, bridge loans by the private sector, lending into unsustainable debt situations, sets a stage for inevitably ultimately having to restructure, or it sets the stage also for a protracted period of no access to capital markets. So I do think to conclude, delays, I think, are very harmful to the country. And I go back to the importance of calling unsustainable debts unsustainable rather than gray.
Thank you, Carmen. Hector?
Sorry, thank you. I want to pick up one thing that Carmen said at the beginning, which is rules are only good when they are credible. And I would add that the fund is only good when it is effective, when it can act rapidly, flexibly, respond to situations that are changing every day. And so having an escape clause to respond to emergency situations is like having a clause that allows you to break the glass, pull out the defibrillator, use it with prudence, of course, but you have to stop something. And if you really straitjacket the multilateral institution that is at the center of all the, I would say, global interdependence that was built since the Second World War, you're straitjacketing. If we straitjacket that institution, then we are just opening even more the window for bilateral solutions. I think that having an escape clause to respond to emergency situations is entirely reasonable. That's why I support the reintroduction of the exceptional circumstances, with all the risk that it implies. I have no doubt about the risk. However, determining the existence of exceptional circumstances must be done with due restraint. There's no question about that. I see it as something that has to be used very seldomly with maybe the board has to approve it with special majorities. But in my view, it is totally appropriate to furnish the fund at this particular times with the capacity to react rapidly and flexibly to situations, because otherwise we're giving more and more possibilities to reshaping a world with bilateral deals. I mean, somebody is going to step in if the fund doesn't step in. So I think risk for risk, I understand the risk of having an exceptional circumstances clause, but I rather feel comfortable with what you are proposing because of that at this time.
Thank you, Hector. Rishi, final remarks?
Thank you, Pablo. Just very quickly, Miranda, great to see you. Indeed, in 2010, if we had had the reprofiling option, it would have given Greece more options. But we also need to remember that Greece was running very, very large fiscal deficits at the time. So it would have still had to do very, very sizable adjustment with all that entails. And of course, Europe did come along over time and provide exceptional support for very long periods of time. On Argentina, 2016, the reform on reprofiling did have the Greece experience in mind. And Hector already spoke about how that played out. I think on Ramiro's point at the ERM, the fact that we now have an enterprise risk management framework, which is quantified residual risk, risk tolerance, whether the board is willing to take on more risks, how to think about it. I think that does provide us an angle. And I think, Pablo, this is exactly what you had in mind, or your report had in mind. I would just conclude by saying we're not in 2017. We have moved on. I think the lessons from 2017 are being incorporated into our frameworks, including the realism tools. They have come in. Nobody disagrees that when debt is unsustainable, it needs to be worked on. There needs to be timely and adequate restructuring that's done. I just don't see gray zone cases as immediately sort of falling into that. I get that there are some issues that one needs to think about further, but unsustainable debt, I think we have no disagreements whatsoever. Pablo, thank you so much for this opportunity. Bye.
Thank you, Rishi. Thank you all also for the flexibility of staying a little bit over time. So thank you to all of you, Sean, Hector, Carmen, Rishi, and thank you also for the participants. I think we are already over time, so I will just finish here. And just to also signal that the next step on the evaluation is the recommendations have been endorsed by the board. So the next step is the management implementation plan on how they are going to address the recommendations, and eventually a reform of the exceptional access policy in due time. Thank you again all for the richful, and I really like the debate, that there was a real differences of views, because it reflects the difficulty of this policy and the different views around it. Thank you again, and
Thank
see
you.
you next time. Bye.
Thank you.
Bye.
Thank you for inviting.